On February 28, 2026, coordinated U.S. and Israeli military strikes targeted Iranian nuclear and military infrastructure. In the immediate aftermath, the Strait of Hormuz underwent a functional closure to commercial traffic. The physical result of the strikes is absolute gridlock. Tracking data shows a sudden collapse in maritime traffic, leaving over 150 crude carriers and LNG vessels anchored in the open Gulf. LNG stands for liquefied natural gas, which is natural gas supercooled to liquid form for global transport. The financial reaction was instantaneous. Brent crude spiked 13% to clear $82 a barrel. The Indian rupee dropped to a record low of 92.18 to the dollar, while projections for the U.S. 10-year Treasury yield shifted abruptly upward. The market is currently absorbing a severe cost-push supply shock, distinct from the demand-driven rallies typical of an expanding global economy. We have to differentiate between field-level scarcity and maritime disruption. Global oil production remains active. The crisis is rooted entirely in the inability to safely move product through a specific maritime chokepoint. This makes the geopolitical risk premium the primary driver of energy pricing. This premium is the specific dollar amount added to a commodity's price to account for the perceived risk of future supply chain destruction. Logistics failures, soaring insurance costs, and abrupt market repricing are triggering a rapid tightening of global financial conditions. This financial fallout represents the true systemic threat, outweighing the immediate concerns over physical oil volume. The Strait of Hormuz is the primary chokepoint in global energy logistics, handling roughly 20% of all petroleum consumption and a significant portion of global LNG exports. The waterway is not legally or entirely closed. A fraction of Chinese and Iranian-flagged vessels continue to navigate the corridor despite the hostilities. The actual catalyst for the freeze is financial. Following the strikes, major global marine insurers, including Guard and North Standard, issued immediate cancellation notices for war risk coverage in the region. Without valid war risk insurance, shipping giants like Maersk and MSC are financially prohibited from transiting the strait. The risk of total hull loss without a payout mandates a full operational pause. The relationship is purely mechanical. When the financial shield of insurance shatters, the physical movement of the vessel stops. The ship is immediately diverted into a holding pattern. This localized risk scales instantly, requiring zero physical barricades to create a massive bottleneck of anchored vessels. This gridlock compounds an already strained global logistics network. With Houthi forces continuing to disrupt the Red Sea, the world is facing a dual chokepoint shipping crisis with no recent historical parallel. Modern energy flows do not require physical military barriers to fail. They are broken by risk models and financial liability long before a single mine is laid in the water. We can observe this financial liability in the crude markets. Following the military strikes on February 28th, Brent crude immediately breached the $82 per barrel threshold. This chart breaks down crude oil price drivers. On the right, green bars representing fundamental demand remain flat, while the price surge is driven by a massive red spike. Bloomberg models indicate roughly $19 of this is strictly a war-related risk premium. The outcome hinges on a single variable, duration. In a short-term scenario where disruption lasts under 4 weeks, this risk premium will likely unwind, capping Brent around $85. If the strait is paralyzed for 3 to 6 months, higher freight costs and insurance rates become baked into long-term contracts, pushing baseline prices toward a sustained $100 per barrel. At the extreme end of the probability curve, major banks like JP Morgan and Deutsche Bank model tail risks pushing crude between $130 and $200 per barrel, specifically if regional energy infrastructure is targeted. Duration is the decisive macroeconomic variable. The length of the conflict dictates whether global markets absorb a temporary blip in volatility or undergo a structural, multi-year repricing of energy. The damage from that repricing is not distributed equally. We have to follow the geographic destination of the Hormuz crude to find the true economic vulnerability. 84% of crude oil flowing through the Strait of Hormuz is routed directly into Asian markets. The national dependency ratios illustrate the exposure's severity. Japan relies on the Middle East for 95% of imports, South Korea 68%, and India 50%. India presents a particularly acute mathematical vulnerability. The country imports nearly 90% of its total crude oil, making it highly sensitive to any fluctuation in the Brent baseline price.
The formula defining this exposure is rigid. Every $1 rise in the price of Brent crude adds approximately $1.4 billion to India's annual import bill. This forces a rapid transmission into the foreign exchange, or FX market, the global marketplace for trading national currencies. A wider trade deficit immediately pushes the Indian rupee downward. In Malaysia, we can measure this exact elasticity. Historical regression shows that a 1% increase in Brent crude currently drives a 0.3% depreciation in the Malaysian ringgit. In the current regime, higher oil prices operate as a direct structural tax on these emerging markets. Instead of boosting cyclical export revenue, the energy spike systematically weakens their domestic currencies. Zooming in from national currencies, this macro fuel shock and the soaring costs of maritime rerouting translate instantly into corporate margin compression on the equity markets. The immediate losers in this environment are highly predictable. Airlines face skyrocketing jet fuel costs, logistics companies absorb higher diesel prices, and FMCG brands, fast-moving consumer goods, see their distribution costs erode profit margins. Indian oil marketing companies, or OMCs, are a textbook example of this squeeze. These firms import global crude at surging international prices, but are politically restricted from raising domestic retail prices at the pump, crushing their margins. The hit also reaches indirect sectors. Agricultural producers suffer as natural gas, a core input for urea fertilizer, spikes in cost. Even IT service firms in India feel the pressure, as Western clients tighten their operational budgets in response to energy inflation. Conversely, structural winners emerge, acting as market hedges. Upstream oil producers capture higher realizations per barrel. Defense contractors attract capital, and non-Gulf LNG suppliers benefit from the instant premium placed on secure, alternative energy sources. The equity shock systematically penalizes macro-exposed, energy-intensive businesses, while rapidly rewarding companies that offer localized resource security. The endgame of this crisis extends far beyond Asian equities. The ultimate stress test lands on Western inflation mandates and the reaction functions of major central banks. This chart models higher oil prices' impact on U.S. inflation. Gray bars show the baseline. Dark blue bars, representing a $25 crude increase, show inflation lifting across all quarters. A 10% oil spike adds up to 0.2 percentage points to inflation. Under a prolonged disruption scenario pushing oil to $100 a barrel, headline inflation would increase by roughly 0.5 percentage points. Central banks will react differently to this data. The European Central Bank, whose inflation is currently anchored around its target, would likely look through the negative supply shock and hold rates steady. The U.S. Federal Reserve faces a much harsher dilemma. The Fed risks entering policy paralysis. Because U.S. inflation is already sticky and above target, the central bank cannot afford to accommodate a second energy price spiral. They would be forced to abandon planned rate cuts. The bond market anticipates this paralysis. Paired with governments issuing more sovereign debt to cushion the energy blow, term premiums rise. This combination threatens to push the U.S. 10-year Treasury yield toward a disruptive 5%. A maritime chokepoint halfway across the world is now directly dictating the baseline cost of capital in the United States. The economic contagion spreads invisibly from the physical waters of the Gulf directly into the terminal screens of global financial markets. The Strait of Hormuz is currently acting as a massive physical amplifier for global monetary tightening. It is crucial to respect the physical timeline of this crisis. Global supply chain disruptions operate on a 2 to 4 week lag. The severe macroeconomic pain, working capital constraints, and corporate earnings hits stemming from today's anchored vessels have not yet fully materialized in the data. If the disruption holds for 3 months, the global economy crosses a critical tipping point. The situation shifts from a painful but manageable risk premium into a global recessionary regime. Institutional investors and strategists must audit their Tier 1 and Tier 2 supply chain exposure immediately. Tier 1 suppliers provide parts directly to your business, while Tier 2 provides parts to your suppliers. Securing alternative logistics must happen now, before the data reflects the reality on the ground. Geopolitical risk has become the baseline math of the new global economy.
a tangible variable that dictates the cost of capital and the stability of trade.